Swayam Prabha. Digital India. Educated India.
Hi all, welcome to this last session on commodity derivatives and risk management, and we will continue with the discussion on different contracts which are traded at LME, London Metal Exchange. As you may be recalling that we discussed about different kinds of derivative contracts which are offered at LME. So let's continue with that discussion. So you have futures and option contracts, as well as traded average price options, swaps, etc. gets traded at LME. Let's quickly focus on what is the trading calendar at LME. So if you can see this particular contract, you have this portion is that it runs from daily, it is this cash to 3 months, and weekly settlement 6 months, and you have monthly settlement goes into 123 months. So what do we mean by this daily settlement? If you recall, normally normally futures contract have monthly expiry, but LME provides futures contract to be taken for 8 days, 9 days, 10 days, 11 days. So if a company is interested to take a futures contract for 10 days or 11 days or any time up to 3 months, that they are free to take, as long as there is counterparty who is interested to take a reverse position. So buyers and sellers can take futures contract maturing any day up to 3 months, and post 3 months there are contracts which are maturing on weekly settlement. Like, let's say from today, if a company wants to take long futures for 3 months 7 days, this company will be able to take, or 3 months 14 days it will be able to take. So this facility is available for 6 months, and post 6 months the company will be only able to take contracts for monthly maturity, and it can go up to 123 months. That is, today some company wants to take a long or short futures for 10 years or little longer than 10 years, 10 year 3 months, that facility is also available, provided there are counterparties to take short futures position. So similarly, there are option contracts are available at LME, and all option contracts have futures as underlying, and so unlike futures contracts, options do not have daily or weekly settlement. All option contracts leads to their monthly maturity contracts, and option contracts, when the contracts expire, the buyers and sellers take long futures and short futures, as we have discussed earlier. A very interesting option which is available at LME, which is known as traded average price option, or TAPOs. So what exactly is a TAPO? If you see, normally a call option will be in the money when the underlying spot price on the contract maturity date is greater than exercise price. That is, we write ST is greater than X, but here if you see, we have not written the T, but we have written the average price. So in case of a TAPOs, the average price is considered as the spot price. So average spot price is considered, and that is compared with the exercise price to arrive at the whether the option is in the money or out of money. And accordingly, if the option is in the money, the option is exercised and the buyer gets the long call position gets long futures, takes a long futures position. Now at LME also there are swaps available, exchange traded swaps. If you recall, normally swaps are OTC contracts, but at LME there are standard maturity, standard lot contracts are available, and buyers and sellers can enter into this exchange traded swaps, which are known as your LME swaps. Let's say a copper concentrate or a copper copper cathode buyer and copper tube seller. Suppose a company which buys copper cathode and sells copper tubes. Its fear is that copper price is going to go up and it will not be able to pass on that price increase to its customer because of there are heavy competition in the copper tube market. So it is fearing that price is going to go up. Accordingly, it will be able to enter into this LME swap to mitigate this particular price. And these swaps are not OTC contracts, these are exchange traded contracts, and these swaps are, if you can see, these swaps are mark to market on daily basis like any futures contract. These swaps are mark to market on daily basis. Also, there is in some earlier sessions we had discussed about the index, commodity futures index. So LMX also LME prepares an index called LMX. So that is your London Metal Index, and this this index takes the value from weighted average futures price up to 3 months for 6 commodity contracts traded at LME. And like any index, you have to have constituent and you have to have the weights. So the constituent comes from the price of these 6 commodities, and what is the weights? Weights are decided based on the average global production of that commodity over the last 5 years and the average trading volume of each of these commodity over the last 5 years. So all these things are taken into consideration to arrive at a weight. So what is the weight for different commodity? It is also available at London Metal Exchange website. So on a daily basis, London Metal Exchange informs what is the LMX value, and also interestingly there is a futures contract on LMX. So people can buy and sell futures contract on the index, that is the LMX. Now let's go to, if you see, this is the this is the data which I have downloaded from Bloomberg to show you how the LMX has moved from. This data is from 2011 to 2016. This LMX has a value of base value of 100, which was in the year 1984. So so this value has, if you can see, around 2011 this was quoting around sometime around 4,000 or odd points. Now it is quoting around 2,400 odd points, which is I mean, all of you know that globally the all commodity prices has gone, metal prices have gone down significantly, and that can be seen from the LMX values. I also did a little bit of small modeling between copper spot at LME and 3-month futures at LME, and if you can see, this value shows the contango and backwardation. I'll make available this particular Excel file for so let me again open this. If you can see this one, so you have during this month of June you have a contango followed by considerable period of backwardation in the copper market. So this particular slide, so this particular Excel file shows the contango backwardation calculation for copper futures and copper 3-month futures and copper spot price from the LME data. Now, with this we will come to what are the key questions with respect to LME as a exchange and LME contracts which are offered by metal contracts which are offered by LME. So, why LME is known as market of last resort, and why LME publishes 3 different prices, that is official, unofficial and closing prices, and how these prices are different from each other, and why LME offers daily, weekly settlement on future contract unlike any other commodity exchanges, what are TAPOs and how they are different from regular options, and why any company would be interested in trading in TAPOs, and finally what are LME swaps. Of course, LME considering the wide variety of contracts which are traded at LME, lots of time can be spent on understanding different aspect of LME futures and option trading. However, for the time being we will be only discussing this, and we will be proceeding with another interesting commodity derivative contract, that is your derivatives on real estate. Okay. So, let us discuss another derivative contracts on very interesting underlying, that is the real estate prices. So, again one thing I would like to tell that the real estate derivatives do not trade in any Indian exchanges. However, there is some development has happened with respect to creation of real estate indices which form the basis for or underlying for derivative instruments. Now, let us go to understand what is a real estate, what are the real estate derivative contracts which are traded in global exchanges. Now, let us first understand little bit on physical real estate market. This real estate market can be categorized as commercial real estate market and residential real estate market, and residential is self-explanatory, I do not need to explain that. However, commercial real estate can be categorized as for real estate for office spaces and real estate for retail stores. And owners of both these kind of real estate, both residential and commercial, can lease these two or rent these two rent these two types of real estate properties. And let us compare the difference between the leasing aspects for these two types of market, these two types of real assets. So, real estate assets. So, what are the difference? Normally, lease period used to be tend to be longer for commercial real estate property than your residential property. And commercial real estate property are normally well taken care of by the lessee, unlike the residential property. And in case of a downturn, economic downturn, the demand for new commercial property slows down significantly compared to residential property demand, and accordingly the price for commercial properties goes down in case of economic downturn more than the residential real estate property. However, this real estate price in general exhibits certain unique characteristics. So, what are these unique characteristics? Housing prices normally tend to be sticky, specifically residential real estate prices normally tends to be sticky in the sense that sellers do not want to sell at a price which is lower than the purchase price. This purchase price acts as a psychological barrier or floor, and if somebody has bought a house for, let's say, 60 lakh or 75 lakh, then they wait till they get a higher price to sell the sell this asset rather than sell it at a lower price. So this is that's why it is residential prices are normally considered to be sticky prices. And residential properties normally exhibit very high seasonality, and it is not only in India, it's all over the world. Residential prices have considerable amount of seasonality. And what is the reason? Specifically in Western countries, US, UK and Australia, people normally do not buy house during Christmas time, so that's the lean period. And in India, you have most real new residential property purchases happen during October to March, that is during your second half of the financial year, that is post Deepavali or during Deepavali. Most of the new purchases for houses happen. So in this context, I would like to discuss little bit on REITs or real estate investment trust, which are being discussed in Indian context in a significant way. However, no REITs have been undertaken as of now, because only recently SEBI has given the go ahead to creation of REITs. So REITs are nothing but a mutual fund. In a regular mutual fund or a equity mutual fund, the unit holders contribute money, and that money is used to create a portfolio, and the dividend from the equity investment as well as the interest from the dividend from the equity investment and the capital appreciation by selling the equity shares get distributed to the unit holders. So exactly REITs function in the same manner. The unit holder of REITs contribute money, and that money goes to create a pool of real estate property, and the real estate property can be rented out, and from the rent unit holders will be given regular income. In fact, REITs are supposed to mimic the rental earning from owning a property. So and REITs provide opportunity to small investors to diversify their investment into another asset class, that is the real estate, with very little capital investment. So if a particular investor wants to own a house, he can do so only by spending considerable amount of money. But with a REIT, maybe 5,000, 6,000 worth of rupees, the investor will be able to take exposure into the real estate market and have REIT as part of its portfolio. Now let's go to what are the different types of derivative contracts trade on real estate. Actually, many real estate indices are calculated by different agencies, and these real estate indices form the underlying for futures and options, which are traded in different exchanges. Let's discuss how some of these real estate indices are calculated and reported. Some of the popular real estate indices are S&P Case-Shiller Home Price Index, Housing Price Index of USA, Halifax House Price Index of UK, and FTSE Commercial Property Index Series of UK, and NHB Residex of India. That is National Housing Bank creates and reports an index called Residex. How this is also calculated, we will briefly discuss. Now let's go to understand briefly how these indices are created. In fact, the whole whole mechanism or methodology of calculation of S&P Case-Shiller Home Price Index methodology is available in this document. If you give a Google search, this document will be freely available. This document was updated last on February 2015, and as you can see, it is a 43-page document which indicates how these case-seller home price indices are calculated, but I'll just quickly take you through how this index is calculated. Now, this set of indices are calculated by Standard and Poor's. So S&P prepares this index. S&P prepares 23 index, and out of this 23 index, 20 indices are for 20 cities in USA, and 3 are composite indices. And these 3 composite indices are for one for national index, one for 10 city index, and another for 20 city index. And all these indices have a base value of 100, which is equated to January 2000. So how exactly this indices are calculated? S&P Case-Shiller House Index follow value weighted repeat sales methodology. Let me repeat, it uses value weighted repeat sales methodology. So what that means, the S&P identifies let's say at a given point of time, given month, let's say in a particular area 20 houses have been sold, 20 old houses have been sold. So it is a repeat sales methodology. It does not take into consideration new houses which are getting sold. So older houses which are already been occupied by some owners, when they are selling those houses, that price gets incorporated into the index. So let's say a particular region, the S&P found out that there are 10 houses have been sold in a given month. So the difference between the original price, the price at which the house was sold for the first time, and the current sale price, so that is considered as a sales pair. Let me repeat that 10 houses got sold in a given month in a given region, and S&P wants to find out the house index for that particular region. So the price at which each of these 10 houses are sold, that price will be paired with the original price at which the houses were, each of these houses were sold. So each house, the original price and the current sales price will be known as a sales pair, and each of these sales pair will be given a weight. So 10 sales pair, 10 weightage will be taken into consideration to calculate the index. Now there are certain precautions which are taken by S&P for calculating these indices. So what are these precautions? So as you can see, all sales pair in a region are collated to form an index. Each sale pair is assigned weights based on the price difference between the pair. So actual current sale price minus the original sale price will be determining the weight. However, sales which are not conducted at arm's length prices will not be considered for index calculation. That is one precaution. The second precaution is sales pairs with longer time intervals are given less weight. So if a particular house has been sold some 15 years back, and now only only after 15 years it is being sold, then, and on an average other houses have been sold at 7 to 8 years, then this sales pair, 15-year-old sales pair will be given lesser weightage to reflect the probability of physical damage, physical change in the house. Because these houses, these indices are known as constant quality house price index. So as these indices are known as constant quality house price indices, so certain precautions are taken by the S&P to calculate these indices. Please see this one. This particular picture shows the value of S&P Case-Shiller index for 20 city composite index and 10 city composite index. So from the 20 cities, some 10 cities has been identified and a composite index is calculated from those 10 city, and the 20 city composite index is also calculated in the same manner. So if you can see, this is coinciding with your subprime crisis, when house prices nosedive significantly. You have and very little buy and sale was happening for the new houses as well as older houses also. The index came down to almost near 2000 level. The 2000 index got created with a value of 100, so it almost touched the 2000 level, and over time this index has been this index has gone up substantially, and it is hovering around 200 value in as of 2016. Similarly, besides this S&P Case-Shiller index, Halifax US price index of UK is calculated, and this index not only takes care of pre-owned houses, it also takes care of new houses. The index is calculated by taking into consideration new house sales as well as second hand house sales. Now let's quickly go to the Residex of India. This is calculated by the National Housing Bank of India. Its base here is 2000, which is equated to 1, and please see this detail. I hope you are able to see this. I'll just focusing on the first city, that is the 2000 index was equal to equal to 100 for Hyderabad, and for different quarter it has been calculated, and currently that is the last data which is available, January March 2015 index. This is quoted at 1997. This, if you can see this one, this is this is 97. Similarly, Chennai is the most expensive in terms of house prices. Chennai, you have 100 value in 2007, and it is 364 by January March 2015. And one thing I would like to mention here, it is not calculated based on old sales, it is calculated based on new sales only. So based on the new sales registration price, this index is calculated, and this does not consider second hand sales of the houses. And how exactly, this is little more detail. Let's say Delhi has a value of 123 for October December quarter, and Delhi, again Delhi is a big place, so which house sales at which locations has to be taken into consideration. National Housing Bank has divided Delhi into certain zones, like let's say 7 zones Delhi has been divided, and this again for each zone they calculate the index, and all these the zonal indices are taken into consideration to calculate the CT index. And as I mentioned, Chennai has in terms of new price in terms of prices of new houses, Chennai has gone up the maximum, that is from 2000 in the year to from 100 value of 2000, it has gone up to 364 by January 2015. And like any derivative contract with underlying, this real estate indices forms the underlying for futures and option contract. So I'll just quickly take you through. Of course, in India it is not available. This is if you can see, this is your at CME, these are the real estate products which are available. You have a Boston real estate futures, Chicago real estate futures. So the underlying is this city or city indices or state indices. So you have composite index futures and options. So that is also, somebody is interested to take a futures and options on the composite index, that is also available. And this is a contract specification for S&P Case-Shiller home price index futures contract specification for, if you can see this one. So what is the contract unit? Contract unit is $250 times S&P Case-Shiller metro area home price index. And what are the product codes? So depending upon different city, somebody wants to take futures position on house index for a specific city, or it could be for the national index. The trader is free to choose. So what are the key questions pertaining to this particular session? Who would be the user of real estate derivative, and how real estate indices are created? How would you identify seasonality in house prices? With this, we come to the end of this 40 sessions, and there are many more contracts which are available for trading, which we could not discuss in detail. In fact, there is a significant amount of trading happens in coal futures. There are also trading happens in fish futures, that is salmon futures are traded, that is animal contracts are traded in terms of feeder cattle and live cattle and hog cattle. So there are contracts on butter, there are contracts on whey, so many other commodity contracts are traded. So in this 40 session, I have tried to cover as many as different contracts. However, this is not this is the commodities which I have discussed is not exhaustive list. And if you are interested to know more about these commodities, how the commodities are contract specification, how these contracts are priced, valued, you can go to the different website and search and learn more about it. And almost all websites provide some kind of a user manual and some kind of frequently asked questions. So from there you will be able to broaden your knowledge. And in India, as I mentioned, commodity derivative has started, though it has yet to reach a critical mass, but I am very hopeful that in near future this commodity exchange will be able to draw a more number of hedgers to its platform, as well as provide many other kind of derivative contracts or provide derivative contracts on many other different underlyings which are not currently available in India. With this, I end my session, and any questions, any queries, I'll be more than happy to contact. If you contact, I'll be more than happy to answer those queries. And also in each of this session, my email address is mentioned. Post this course anytime if you have any query pertaining to commodity derivatives, I'll be more than happy to answer and interact with you all. So thanking all of you, and today I cannot say that looking forward to interacting with you, because this is going to be our last session. Once again, I hope you will enjoy this for seeing this video, these 40 videos, and learn about commodity derivatives. Thank you all of you.